A very good afternoon to all of you. Thank you for joining us this afternoon, a summer afternoon, very hot in Dubai and in Saudi. But thank you very much, all of you, for joining us. Today, we are going to talk about withholding taxes in Saudi Arabia, and we'll also be looking at the nitty-gritties of what lies within the ambit of withholding taxes. So without much ado, I'll just ask to go on the next slide. Yep, so this is the agenda that you see on the screen. So we'll be starting off by giving you a quick overview of what lies in Saudi Arabia in terms of taxation. This is just a very brief overview. We'll then jump onto the scope of withholding taxes in Saudi, starting with who is it applicable to, what are the rates of withholding taxes, and does it apply to all payments or certain types of payments. We'll then talk you through the withholding taxes compliances, which are supposed to be complied with by withholding taxes agent in Saudi, along with certain filing obligations. In the next section, which is about the international perspective, we will very quickly take you through the double tax treaties, which are being concluded by Saudi Arabia, how it helps in reducing or eliminating double taxes and lowering or sometimes even eliminating withholding taxes in Saudi. What are the practical steps to effectively apply these double tax treaty rates? And last but not the least, we'll also touch upon how to claim foreign tax credits in Saudi Arabia. We'll, towards the very end, we'll also talk about certain common pitfalls that will definitely help you to avert crisis and penalties as a result. So that's also something that we are going to speak about. Last but not the least, we'll open the floor to Q&A for you guys to chip in. So without much ado, let's look at firstly the overview of the Saudi tax landscape. So we begin with corporate taxes. Now, corporate tax is not a new thing in Saudi Arabia. This has been there, for a long time, 2004 and onwards. As you can see on screen, generally Saudi corporate income tax is at the rate of 20%. It is applicable on the net adjusted profits of Saudi resident companies, but to the extent of non-residents share in the company. So just to give you a very quick example, if a company is 75% held by a non-Saudi shareholder, then to the extent of that 75% of the net adjusted profits, 20% corporate income tax will apply. On the balance 25%, which is the share of the Saudi or GCC nationals, zakat is generally applicable at the rate of 2.5% on the zakat base. We then look at withholding taxes in Saudi Arabia. Now, withholding taxes applies to cross-border payments. Effectively, domestic payments of transactions are not going to be subject to withholding tax. It is only the outbound payment of outbound payments which will be subject to withholding taxes. Again, the withholding tax rate ranges from 5% to 20%, depends on the nature of the payments. Last but not the least, I think we are all aware that there is value-added tax. Currently, the VAT is applicable at the rate of 15%, and this may also apply to inbound services where a non-resident renders services to the customers or recipients in Saudi Arabia. 15% VAT could apply. Just going on to the next slide and giving you a very brief overview specifically on the scope of the corporate income tax. Now, as you can see on the screen, who are the persons which are subject to corporate income tax in Saudi Arabia? We'll start and we'll first divide it into two broad categories. One is the resident persons and one is the non-resident persons. When we talk about the resident persons, effectively, there is a whole lot of companies which are engaged in oil and hydrocarbon production business. For them, the corporate income tax rate is ranging from 50% to 85%. And there is other resident capital companies to the extent of shares which is held by the non-resident, non-Saudi persons. It is going to be subject to tax at the rate of 20%. You would also have non-Saudi natural persons who are conducting business in Saudi Arabia and who are resident in Saudi Arabia. They would also be subject to corporate income tax of 20%. And persons who are engaged in the field of natural gas investment, they are also subject to corporate income tax at the rate of 20%. Now, on the opposite end, we have the non-resident persons. Now, generally, non-resident persons are subject to corporate income tax in Saudi Arabia if they have a permanent establishment in Saudi Arabia. What do we mean by a permanent establishment? It could cover establishments like a branch or a construction site. It could also cover sometimes a service permanent establishment wherein the duration of rendering services in Saudi Arabia exceeds a particular threshold, for instance, 183 days. Or it could also be in situation where the non-resident person engages and works and operates his business in Saudi Arabia by way of a dependent situations. The permanent establishment, the so-called permanent establishment of the non-resident person, will be subject to tax at the rate of 20%, limited to the profits which are attributable to effectively the permanent establishment. Last but not the least, there is non-resident persons who would be earning income from Saudi Arabia without having a permanent establishment, effectively non-resident persons who have a source of income in Saudi Arabia. In certain situations, depending on the nature of these payments, withholding taxes could apply. And the withholding taxes, like I mentioned, ranges from 5% to 20%. So this is just a quick overview. I'll hand it over to my colleague Noura, who is going to walk you through the nitty-gritties of the withholding tax. Noura, over to you.
Assalamu alaikum. Hello, everyone. Thank you for taking the time to join us today. In today's session, I will walk you through the domestic withholding tax procedure in KSA, including the tax rate and compliance obligation. Let's say a non-resident receive income sourced from KSA, whether it's actual income or income deemed source under the local rules. In this case, the KSA resident making the payment is considered the withholding agent. They are responsible for assessing the nature of the payments, determining the applicable withholding rate, filing the monthly withholding return, and remitting the tax to the tax due to Zakah. When a non-resident receive income from KSA, it's important to determine whether this income is subject to CIT or withholding, or if it's outside the scope of the KSA taxation. For example, if the contract relates to a pure supply of goods with no services provided, the transaction is generally outside the scope of the withholding. However, if the contract of the good includes services, the income portion relate to the service would fall under the scope of the withholding tax. On the other hand, if a service is provided from outside KSA to KSA resident entity, it may be subject to withholding, meaning if the benefits of this service is enjoyed in KSA, it would be subject to withholding tax. Next slide, please. Yeah. The withholding is applied on the gross amount of the income. The withholding tax rate is depending on the nature of the service. We have summarized here in this table the withholding rates, such as the management fees would be subject at 20% rate. The payment for technical and consulting service would be subject to 5% rate, and all payment which do not fall within a specific category would be subject to a 15% rate. Here we have an example. A UK-based engineering consulting company provides a design services to KSA construction firm. The total contract value is 1 million riyal for service rendered. The UK company has no presence in KSA. However, since the benefits of this service is used in KSA, such income will be subject to 5% withholding as a technical and consulting. Then the KSA client must deduct the 50,000 and remit it to Zakah. Next slide, please. Okay. Moving on the compliance aspect of the withholding in KSA, the withholding agent is obligated to withhold tax on payment, and it must submit and file the withholding return before the statutory deadline. The withholding agent must also submit an annual withholding form at the end of its tax period, summarizing all the relevant information for the period. The KSA entity remain obligated to maintain records and keep supporting documentation to verify the correctness of the tax withheld amount. A failure to pay the withholding tax or submit the withholding return result in a 1% penalty of the unpaid tax due. Here in the international perspective, I will leave the ground to my colleague Nana.
Thank you, Nirav and Nora, for the insightful overview of the domestic tax. And thank you, everyone, for joining us today. Now I will take you through the international aspect of our topic, specifically how Saudi Arabia navigates the cross-border taxation through its extensive network of double tax treaties, which is currently over 56 double tax treaties. This is a critical area for businesses and companies operating across jurisdictions. So the double tax treaties are designed to prevent the same income from being taxed twice, once in the source country and once in the resident country, and to help businesses to reduce or eliminate the double tax under each double tax agreement. In practice, if double tax treaty agreements provide a more favorable tax rate or an exemption, which is different than the domestic tax law, then the treaty will generally prevail and override the domestic law. But to benefit from the withholding rate reduction or the exemption, the non-resident service provider must initiate the request and ask the client in Saudi Arabia to apply for the refund or the upfront exemption method. We have included here a summary of some of the required forms and letters, and ZADCA may request additional documents to evaluate and support the treaty relief. Using here the same example that we had before, which is the UK company providing design services. So according to the domestic law, the payment here would be subject to 5% withholding. However, if the UK company requests the treaty relief, then under the treaty provisions, the technical and consulting services may benefit from an exemption, and it would be subject to a zero rate instead of the 5% withholding tax. The withholding resident still must report that transaction, even though they don't withheld any amount. They have to report and provide all necessary documents to support the double tax treaty claim. And as we said earlier, the relief is not provided automatically from ZATCA. It has to be initiated and requested by the non-resident service provider, and there has to be a cooperation between both the KSA client or the KSA resident and the non-resident service provider. Going now to the foreign tax credit claim. So even though we have double tax treaty agreements, some situations the foreign tax would be still applied. So the same income would be subject to taxation twice in Saudi and in the resident country. For example, royalty payments under certain double tax treaties, the withholding rate would be reduced from the 15% as per KSA law to 8%. Here we have a double taxation in Saudi and the resident country. Therefore, we have the article of elimination of double tax treaty. This article would be applied both in Saudi Arabia and in the other jurisdiction that is signed with the double tax treaty. The common methods to achieve this objective, the full exemption method and the tax credit method. The full exemption method here is to eliminate or remove the foreign income from the taxable income, or the credit method would be providing a credit to offset the taxes paid abroad. ZATCA will require specific documentation to be submitted to be able to benefit from the tax credit. And as you all know, the income tax law does not allow a deduction of any taxes paid, whether the tax paid inside Saudi Arabia or outside Saudi Arabia. So KSA resident companies who operate inside and outside Saudi Arabia and they generate income, let's say from the UK, and it gets taxed in the UK, they can request ZATCA to provide the credit. Going to the next slide to elaborate more with an example. We have here a KSA resident company operating in KSA and another jurisdiction. For the year 2020, the company has a gross income of 100,000 riyal. 60,000 of that income is generated from Saudi Arabia and 40,000 from the source state. The source state applies 30% tax on that income. However, under the double tax treaty agreement, the elimination followed is full exemption. So when the KSA resident compute the tax return, they will have the gross income of 100,000 and they will remove the foreign sourced income, which is the 40,000. The CIT base will include only the 60,000, which is generated from Saudi Arabia and will be applied, the 20% rate would apply on that 60,000. The same example here, but applying the credit method, the ordinary credit method, which is what ZATCA follows in some of the double tax treaty agreements. As we said earlier, the 40% is generated from a different jurisdiction, and that jurisdiction subject the 40% to 30% tax, which means 12,000 Saudi Riyal was paid to that jurisdiction. When we compute the corporate income tax, the credit applied here is only limited to the amount of tax that would have been paid if the income was generated in Saudi Arabia. So it's only limited to the 20% rate, which is 8,000. While the taxpayers can benefit from the treaty relief incorporated within the double tax treaty agreements, zakat payers are outside the scope of this tax credit method. And currently in the new regulation, zakat regulation, the tax and zakat paid are allowed as a deduction if supported with the right documents. We have included as well an example of the countries that have double tax treaty with Saudi Arabia that apply the ordinary credit method and the countries that apply the exemption method. That's a wrap for the international perspective and the key mechanism in place that is followed in Saudi Arabia. We have here highlighted the common pitfalls and the areas that should be taken care of when filing the withholding and remitting the obligations to ZATCA. First, we have documentation. If the KSA client does not have the proper contracts and a clear service clarification, ZATCA may assess higher withholding rates, and then the penalties would apply. We have here also the gross up of errors. If a contract is showing the amount net of tax the withholding agent, the KSA resident, should be careful and should gross up the amounts that should be subject to withholding to avoid any assessments later on by ZATCA. Third, even though the tax is a responsibility, even though the tax is the obligation of the non-resident, but it's still a responsibility of the withholding agent to withhold the amount and to remit it to ZATCA. The permanent establishment exposure at this point is for the non-resident service providers. When they provide services inside Saudi Arabia, they should take into account the PE exposure and assess whether their presence in Saudi triggers the PE or not. Lastly, the correct payment classification, as misclassifying the type of payment, for example, classifying the royalty payment as technical and consulting would result in a different withholding rates, and then ZATCA would again issue an assessment resulting higher withholding due and including penalties. We hope everything is clear by now, but we have the Q&A session. If you have any questions or need further clarification, we're happy to address your queries. And thank you all again for joining us.
So yes, Dana, I think we have a couple of questions. Maybe we can quickly go into the Q&A box and maybe answer a few questions, yeah?
Yeah, sure.
So I think one of the questions which came up, is that under what situation do we consider that there is a benefit derived in Saudi Arabia? So an interesting question, and I think it is an important one as well. And one of the examples is that where let's say a non-resident service provider is rendering, for instance, training services to a Saudi company, and the training is actually held outside of Saudi Arabia, effectively utilized outside of Saudi Arabia. In this situation, whether withholding tax would apply or would it not apply? Dana, what do you think?
Yes, so if the training is happening outside, but the trainees are still receiving the training from inside Saudi Arabia, then it would be subject because they're still receiving the benefit inside Saudi Arabia. But if the training is fully conducted outside, the trainees are traveling to that jurisdiction, then it shouldn't be subject.
And this is, I presume, regardless of the fact that the payments will be made from Saudi Arabia, right?
Yes.
Perfect. So that's how I also read the law. I think we got this question early on. There are a couple of other ones as well in the background. Let me read one of them. Can we get withholding tax certificate from ZATCA through online automatically?
Yes.
I think there is a process, and it is not automatic, but we can still go online and we can apply for the withholding tax certificate as a withholding tax agent. So this is still possible. Next in line, I'll just take this interesting one. So Sachin is asking, is there a double tax treaty between Saudi Arabia and UAE based on which UAE entity can claim a relief? The answer to this is yes, there is a double tax treaty between the two countries. Will the technical services in withholding tax perspective include the support services like audit, payroll, etc., or only services related to technical aspects? So I think the definition of technical services here is very wide, and it not necessarily only relates to audit or payroll services. It is much wider, and it could include, consultancy. It could include technical services of different kinds, and not necessarily related to finance or related to a particular topic. It is very wide. I don't know, Dana, if you want to add something more to it, or even Noura.
No, I think, as you mentioned, it is wide, but again, it should be carefully analyzed through the provision included in the double tax treaty.
Absolutely. Makes sense. So that's one less. Okay.
We have here another question from Esmeralda. The question, if the payer for services does not withhold, from whom ZATCA demands the withholding? So as we mentioned earlier, even though the obligation lies within the non-resident, it should be deducted from the non-resident income that is generated from Saudi Arabia. The responsibility still falls on the resident payer, the KSA resident, to withhold the amount and remit to Zatka. If Zatka finds out later that the withholding agent failed to withhold this amount, Zatka would issue an assessment and require the payment.
Perfect. I also have one more question from Heinz. Heinz is asking, is there some withholding tax adjustment where a credit note is received against an earlier invoice on which withholding tax was deducted and paid over? So yes, there is in fact an adjustment which would be required in such cases where a credit note is later on issued, and there must be an adjustment, and this is also subject to Zatka approval. So there is a set process which we need to follow, and we need to adjust the withholding tax in the given scenario, Hans. I think there is one common question. I don't know, Donna. I think you might have a better view on this. I'll speak out the question from Tatiana. Is upfront relief automatic? Can the resident client apply the treaty-based withholding tax exemption without prior authorization from Zatka? And she continues, she says, who is responsible for requesting the withholding tax refund, the resident client or the foreign service provider? Can the withholding tax credit refund be made directly to the foreign service provider's bank account?
So as highlighted during the session, the exemption or the refund mechanism under the double tax treaty is not automatic. It should be initiated by the non-resident service provider. They should communicate with their KSA client to apply the withholding exemption or to apply for a refund if the withholding has been already submitted and paid to Zatka. But again, the process here needs a cooperation between both the non-resident service provider and the withholding agent. But sure, it should be initiated by the non-resident service provider. The credit amount, what Zatka follows is it should be refunded to the withholding agent. The withholding agent then refunds it to transfer to the non-resident service provider.
Perfect. So effectively, the withholding tax will be received in the local bank account of the withholding tax agent, yeah?
Yes.
Perfect. Also, Peter is asking, could we have a copy of the slides? Yes, Peter, we are going to circulate the slides later on. Okay, one more question from Natalia. For online training, should be the same approach, no withholding tax on training? I think maybe if I can answer that. So effectively, online training, again, if the recipient are sitting in Saudi Arabia and receiving the services within Saudi Arabia, then withholding tax would still apply unless the recipient or the people attending the training, they go outside of Saudi Arabia and attend it online from a different part of the world. Then yes, withholding tax may not be levied in those situations. Yeah. Okay, interesting one from Salah. If we are claiming upfront double tax treaty benefits, how to report the same in monthly withholding tax return without paying tax? Do you want to answer that, Dana?
Sure. So you will have first to analyze the double tax treaty agreement to understand whether a full exemption is provided, like the zero rate, or if a reduced rate should be included in the withholding return. But again, the documents should be submitted along the withholding return that is being filed for Zatka to review and to make sure that all the process and documents required are available and that the non-resident is allowed to benefit from this double tax treaty reduction or exemption.
Perfect. We have one more question. I'm going to read it out from Jinsha. What is the withholding tax rate for permanent placement service received from UAE establishment to appoint an accountant in KSA? I think I don't have all the details, but what I can understand it, I'm just going to repeat it again. Sorry about that. What is the withholding tax rate for permanent placement service, which is like a manpower service to begin with, received from a UAE establishment to appoint an accountant in Saudi Arabia? You want to take that, Dana? What do you think?
I think the question is not very clear, but if the UAE entity has a permanent establishment in Saudi Arabia, then it wouldn't be actually subject to withholding. It would be subject to the corporate income tax at a rate of 20%.
Correct. But I think what I can make out is that this service in question is on the placement of a resource in Saudi Arabia. So it's more of a manpower service which is rendered by a UAE entity to a Saudi company. So in that situation, such services of manpower placement services, so-called, whether that will be subject to withholding tax and under which category? Do you think it will fall under
Depending,
the technical services, maybe? Not sure still.
I can't say technical because we will have to analyze the nature of the services this manpower are providing. So if they're providing services that are technical in nature, that require specialized service, then yes, it would be 5% withholding under the technical services. But if they're providing managerial services, or it depends on the specific details of the services provided.
Correct. And there is also this one category of other payments, right? It could also fall in the other payment category, yeah?
Yeah.
Okay. Mozam is asking one question. Is it reasonable to assume all GCC countries have double tax treaties with each other?
No.
I think it's not a mandate, Mozama. It could be a scenario where I don't recall of which countries still do not have a double tax treaty. A majority of them does have a double tax treaty between them, but it's not a given. We can check if you have any specific countries in mind, yeah. But definitely UAE and Saudi, they do have an effective double tax treaty. So I've got one question from Marwan. For corporate income tax, up till what level of ownership KSA company will benefit from GCC ownership for corporate tax exemption? Sorry, I'm not really clear on your question, Marwan. Maybe you can just give us a bit more details on that. We'll take, meanwhile, another question from Nisha. When you have not deducted withholding tax from the supplier payment, are you required to gross up the amount or just charge 5% or 15% on the amount of payment made? Dana, you want to take that?
So it should be so the withholding should apply on the gross payment. If you have already made the payment without deducting the withholding, then you should gross up the payment to deduct the 5% and remit to Zatka.
Okay, perfect. We have another one from Joanna. Supposing you have a payment abroad that falls to be under exemption, you have to file a withholding tax declaration first, then file a refund, or you can file a zero withholding tax declaration and file a relief in parallel. So I think if I were to answer that, effectively, it will depend firstly whether a double tax treaty benefit is available or not. If a double tax treaty benefit is available and you are able to provide all the required documents to Zatka at the time of submitting the withholding tax declaration, then effectively you can claim the outright exemption. If you cannot give all the documents, then effectively you will first need to pay it and then claim the refund of it. Yeah. So those are the two possible options. Okay, one more question from John. If we provide manpower services to a client in Saudi, but the contractors are deployed outside Saudi, will there be withholding tax? So John, I think insofar as the benefit of the services are not, the economic benefit, I would say, is not received in the country in Saudi Arabia, regardless of the fact that the services are rendered to a Saudi company, to a Saudi resident company, withholding tax should not apply because the benefit is received outside of Saudi Arabia. I'm just looking at a few other questions. Interesting one. Is there a difference in rate if the payment for technical services made to a related party and to a non-related party? Is the rate any different? Rana, you want to take that, or Noora?
So the rate should not be different. If it's technical services received, then it's 5%. Yes, previously, before September 2023, it was 15% if the service is from related party. But now, any technical services, whether related or from non-related party, the withholding rate is the same 5%.
Mhm. An interesting one. Since management fee definition as per the law mentions ship management services and is a bit vague, normal regional head office management fees should be considered as technical fees subject to 5 or other services subject to 15. Rana, do you want to take that?
Well, like specific questions like this, we can't really be sure what's the nature of the service provided. So it actually depends on the wording of the contract and the actual service being provided to be able to specify whether it's going to be 20 or 15.
I think that's very important in Saudi Arabia that Zatka is going to go through these documents in the background when they do an assessment, right? And that's the reason it's very important to actually go through the documents, find out the real intention of the contract, and then apply the withholding tax category and rates. Yeah.
We have here a question on the time window. So Amin is asking if there is a time window to claim benefits under the refund method to utilize the double tax treaty. So as per the latest guideline issued by ZATCA, the time frame to benefit from the refund is 5 years. 5 years from the payment date.
So I think a lot of people are asking questions effectively on what is going to be the withholding tax rates on certain kinds of services. Just like Dana mentioned, I think it is very important to go through the contract and then comment on it. Going by the face of it, one can arguably put it under one of the apparent categories like technical services or management fees or other payments and so on. But like the rates are varied, and it will be very important that we go into the details of the contract and then find out under which category will that particular service fall and then apply the rate. So we will not answer those questions in specific, yeah, just for the sake of clarity.
We have here a question from Giovanni about the technical services. So Zatka circular letter mentions that technical services are always subject to withholding, even if entirely performed abroad. Yes, that's correct, and that's what we mentioned during the session. Technical and consulting services, whether performed inside or outside Saudi Arabia, it will be always subject to withholding 5%. So the presence inside the KSA is not required for the withholding to be applied. Someone is asking if the webinar will be recorded and whether it will be shared.
I think we are recording the webinar. We will post this on the YouTube, so you can still go back to it and check it out. Yeah. One question from Rafael is asking, can double tax treaty be still applied even if the counterparty country does not have corporate tax enforced? Example, UAE prior to 2024. We have some live study on that, live case study on that, Dana. Prior to 2024, were we able to apply the double tax treaty between UAE and Saudi, for instance?
It actually, this one is still like risky with Zatka because there is no double taxation happening on the income sourced from Saudi. So while the UAE resident requests to benefit from the double tax treaty, Zatka could argue that there is no double taxation happening because there is no CIT in the UAE prior to 2024, and therefore may reject the application.
Yes, highly likely that it might get rejected. Yep.
Okay, we have a question from Mahmoud asking about if the automatic benefit at source relief is allowed in KSA. Yes, as we mentioned before, ZATCA has two methods when applying the double tax treaty. One of them is the automatic benefits, provided that the company provide the necessary documentation, including the Q7C and the Q7B.
I think Abdul Rahman has a question. How does ZATCA view payments made to group treasury centers or shared service centers located outside of Saudi Arabia? I think in the given scenario, are we talking about the actual payments which is made out for from an investment point of view or a cash pooling point of view? Or are we talking about the underlying service which the overseas entity is rendering? I think the one which is the services provided by the overseas entity. It will again depend on the contract between the parties, whether it is taking the color of a loan, and therefore there is an interest, and that interest could be subject to withholding taxes, or is it like a fixed fee or a technical fee that is being, or a management fee rather, which is being charged by the overseas entity, and that could also be subject to withholding tax under a different category. So naturally, it depends on the contract between the two parties here. Harun is asking, the withholding tax certificate issued by ZATCA contains the name of foreign entity whose withholding tax was deducted. I think the answer is yes, it does mention.
Okay, we have a question from John. He's asking about the withholding certificate should be requested by the KSA resident or by the non-resident. The KSA resident has the option to request the withholding certificate from ZATCA's portal directly and then provide it to the non-resident entity.
Okay. I'll take one more question from Mozam. Withholding tax is applicable on repayment of short-term working capital cash loan to related party based in UAE. So effectively, the loan component or the principal component is not subject to withholding tax, but the interest is. So as long as it is merely the principal component, it shouldn't be subject to withholding tax.
Okay, we have a question from Ayman. He's asking about if the withholding treaty reduce the tax to 0%. No, the withholding treaty may reduce or eliminate the tax percentage depending on the type of the income and the relative contracting state.
There's one question which is interesting. Is it possible for the withholding tax agent to apply withholding tax on payments not included in the double tax agreement in place with a specific country? Is the local payer entitled to withhold the withholding tax from payments different from those included in the double tax treaties? I think here it is at the foremost. It is very important to understand the sequence in which we need to apply the double tax treaty and the withholding tax provisions in the domestic cases law. The first part is where you assess the type of the payment from a local withholding tax point of view, which is the domestic Saudi regulations point of view. If it fits in one of the categories as per the local law, then we go into the double tax treaty and find out whether the double tax treaty also recognizes the payments in a similar way, and is there a lower or withholding tax applicable? It could also be at the rate of 0. So whether that provision is there in the double tax treaty or not. If the double tax treaty does not recognize that payment in any one of those specific articles, then effectively we'll go back to the domestic law, and the domestic law should prevail in that situation. Yeah. So an interesting one is VAT applicable on withholding taxes. We received a recharge invoice from our shareholders, which included withholding tax as a separate line item and a 15% levied on the withholding tax amount. Is the treatment correct? Can we claim input VAT on such withholding tax? Dana, Noura, have you ever seen this?
I actually haven't seen VAT being applied on the withholding. There is no tax on tax.
Yeah, absolutely. And especially VAT, which is which is naturally, like we mentioned towards the very start of the webinar, whenever there is going to be inbound services and the recipient is generally a tax resident, or sorry, a tax registered recipient from a VAT point of view, it is generally under the reverse charge mechanism, the so-called RCM. So we do not expect to see any invoices with a VAT on it. If there is a foreign VAT already applied for whatever reasons, the withholding tax would still take into account the gross payments and not the net of tax payments in those scenarios still. So not really, there's no question of recovering any input VAT in these scenario. Yeah. So Eileen is asking, is there a difference depending on the payer is a related party or a non-related party? I think previously it was important to identify related or non-related party because the withholding tax rates were different on certain payments. But now that distinction is gone away, and it's simply at the rate of 5 in most of the cases, or it could be still under other payment categories there. So we still have some time. Let's pick up one more question.
So we have a question here from John. If our Saudi vendor failed to withhold from us and later found out that they should have withheld through an audit, can they get back to us and recover the withholding? Or are they liable now for failure to assess the applicable withholding correctly in the first place? So, as we mentioned earlier, the withholding obligation is still a liability of the non-resident service provider. So it should be deducted from that income generated by the non-resident. But the responsibility here lies with the withholding agent in KSA. Failure to do that, and if they are able to recover the amount from the non-resident, this is actually depending on the contractual agreement between both parties, and if there is a clause in that agreement that says the KSA withholding agent can come again later to claim any taxes due on that income or not.
Interesting. Yeah, one more question from James. James is asking, would the withholding tax rate for technical services differ depending on whether the services are rendered inside or outside Saudi Arabia? Yes. Typically, when you say the services are rendered, so if the services are rendered from inside or outside Saudi Arabia, generally there could be PE provisions which could apply, but in a situation where there is no PE of the non-resident, presumably the withholding tax would apply at the normal rate and at 5 if it is technical services. Yeah. Okay, we'll take one more question.
Yep. From Marine. So she's asking about a UAE branch of a French entity rendering technical services to a KSA client and asking whether the France and KSA tax treaty is applicable in this situation. So based on your question, we understand that the UAE branch is the one providing the services to KSA client, and therefore the treaty that should be applicable is the KSA and UAE, because and also it should be analyzed whether this is passed through or not. But again, if it's technical services and directly provided from the UAE branch, then the applicable treaty would be the UAE KSA. And the provision of that double tax treaty should be analyzed because some of them require the application depending on the residency of the beneficial owner, of the ultimate beneficial owner.
Perfect. Agreed. I think Sami is asking one more question. Is it possible to submit a ruling to ZATCA to secure a certain percentage of withholding tax based on the applicable double tax treaty? I believe there is a provision to submit tax rulings with ZATCA, and this could be one of the areas where there is technical difficulty or uncertainty to find out what rate is applicable depending on the nature of the service. And under that pretext, yes, one could submit a ruling request to get the answer. We have 4 minutes left. We can still take a few more questions. So yeah, Ahmed is asking, does withholding tax apply only on the value of the service or the entire amount? For example, non-resident has provided TNC services to KSA-based entity. When the non-resident raises the invoice, there are two components: the value of the service itself and reimbursable cost, such as flight tickets, car meals, etc. Will the KSA apply only on element one or on the entire amount? Dana, do
So,
you want to take this?
yeah, in this case, usually the value of the technical service should be subject to withholding, and the reimbursement, if it's invoiced separately, without any markup, then it shouldn't be subject to withholding, but there have to be supporting documents. But also we have to highlight here, if these invoices or reimbursement are necessary for the technical service to be performed, then Zatka might take the view that this is a necessary expense for the technical service to be provided, and therefore the total value would be subject to withholding. So there is a room for discussion here with Zatka.
One more question. If a Saudi vendor failed to withhold from us and later found out that they should, I think we have taken this one. Okay, let me take this off. Is there a related guidance from Zatka which we can refer to in relation to grossing up of payment? I haven't read anything about grossing up of payments from Zatka so far. I don't know, Dana, do you have any experience on this?
No, there is no specific guideline from Zatka on grossing up, but there is guidelines for the double tax treaty and the withholding tax.
Perfect. Which I think they have also updated twice. Yeah. Okay, just one last question before we depart. Parent company in USA paid for the expenses of KSA company. Now the parent company is invoicing that expenses without any markup, means simply reimbursement of expenses paid. Is there a withholding tax applicable?
I think we've answered the similar question above. So if it's purely reimbursement of expenses with no benefits or services being provided to the KSA company, it shouldn't be subject to withholding, like it's going to be outside the scope. But again, you have to analyze that before reaching to this conclusion. We're providing here from high level because we don't have the details, but if it's only reimbursement, not related to any service, then yes, it shouldn't.
Correct. I think Marine is asking one practical question just before we depart. Practical questions on Q7B documentation. To benefit from the treaties withholding tax exemption, a Q7B form signed by foreign tax authorities must be produced and shared with Zatka. However, some foreign tax authorities, such as Indian or Argentinian tax authorities, refuse to sign such document. What should we do in this situation to benefit from the withholding tax double tax treaty exemption? Is there an alternative documentation that could be provided? Any experience on that, Dana, Nura?
Usually for the double tax treaties, we've never seen authority that rejects to sign the Q7B. But if this is the case, then it's advised that you reach out to Zatka to elaborate and give them the full information to see how they can proceed with the double tax treaty request, because the form Q7B is one of the required forms. So if that is not completed, then it should be discussed with Zatka to see how they can apply the relief without this form and if there is an alternative.
Perfect. Yes, I haven't also seen any authorities reject Q7B from being signed. But yes, I think I agree with you, Dana. It is something to be discussed with Zatka and picked up with them. Perfect. Thank you, everyone, for your time. We've taken quite a few questions today. And thank you so much for joining us. We'll circulate the deck and also you will see the recording of this session on YouTube soon. Thank you again.
Thank you.
Thank you, Nura and Dana. Thank you.